Good morning, everyone, and a very warm welcome to our webinar today. Doom or Boom, the future of trusts in the UK tax landscape. I'm Leslie Walker. I'm Head of New Business and Marketing here at Sentient International, and I'm delighted to be the moderator for what promises to be a timely, thought-provoking, and above all, practical session today. As you know, the UK government's decision to scrap long-established domicile rules has sent ripples and, in some cases, waves across the private wealth sector. So for the trustees, families, advisors, and structuring professionals, the question isn't just what's changing, but what now? Is this the start of the end of offshore structures, or is it the beginning of a smarter, more resilient planning era? Let's have a look at our agenda today. So first, we're going to look at the new UK tax landscape, including the introduction of the Foreign Income and Gains Regime, or FIG as it is more commonly referred to. We'll walk through two fictional but highly relevant case studies. There's Fatima, whose situation explores FIG planning alongside Islamic finance and succession matters, and Fabrice, who is a long-term UK resident facing shifting trustee risks and complex structuring decisions. We'll also unpack the statutory residence test and its increasing importance under the new framework. And to close, we'll explore how offshore structuring, particularly in jurisdictions like the Isle of Man, can continue to play a valuable role for internationally mobile families. You're also going to hear a trustee's perspective from us here at Sentient International, and then we'll finish with a Q&A, so please do use the chat function to submit your questions as we go. We know time's precious and our aim is to give you practical takeaways, not just policy headlines, so without further ado, let me introduce you to our speakers today. I'm delighted to be joined by a fantastic panel, each bringing a unique lens to the impacts of the 2025 UK tax reforms and what they mean for trustees, advisors and clients. First, we have my colleague and Business Development Executive here at Sentient International, Neil Harris. Neil is a seasoned trust and corporate service professional, bringing over 20 years of expertise in international trust management, with specific expertise in managing complex wealth structures for high net worth and ultra high net worth families. His career began in the Isle of Man and has since seen him work in Geneva, where he honed his skills managing multi-jurisdictional portfolios, particularly with UK resident non-domiciled and South African clients. Next, we have Yusufa Hazara, who is Legal Director at Irwin Mitchell. Yusufa specialises in multi-jurisdictional wealth planning, international tax, and trust and succession planning for high net worth and ultra high net worth clients. She's recognised for her expertise in complex cross-border estates and helping families structure their wealth to safeguard against tax, creditor, and succession risks, including Islamic Sharia compliant solutions. Yusufa's practical experience spans advising trustees, beneficiaries, and international families on issues like inheritance tax reliefs, offshore trust structuring, and the intricacies of UK residence and domicile rules. Lastly, but by no means least, we also have Jessica Fazone, who is also from Irwin Mitchell, a senior associate there. Jessica specialises in advising on the international aspects of UK tax, with a strong focus on structuring for tax efficiency and succession planning. She acts for high net worth individuals, non-UK domiciliaries, family business owners, family offices and offshore trustees, often project managing complex multi-jurisdictional restructures. Jess also leads Irwin Mitchell's Lusophone practice and is a key member of their French desk. Together, they are going to help us make sense of the new tax changes, challenge assumptions, and bring theory to life through some real-world case studies. So without further ado, let's take a look at the current UK tax landscape, and I'll hand over to Yusufa.
The classic error on mute. Thank you, Leslie. Thank you, everyone, for joining us. So why are we here today when the sun is shining brightly? And I hope it's bright wherever you are. So as you probably all know, there has been a huge shake-up in the UK tax landscape, especially for clients who've relied on the non-dom status and the remittance basis of taxation. And if you are an advisor, you've probably been very busy taking a lot of questions from clients and also trustees about what this all means. In particular, will trusts still work? Is this the end of the offshore planning as we understand it? Or could this actually be an opportunity for new work? And that's what we're here to explore today. Is it doom or boom? And lucky for you guys, if you have to listen to the end to work out and understand what we all think about this question. I thought it would be helpful that we take a step back and remind ourselves where we've come from. So before the concept of domicile goes back centuries. It originated in Roman law and was adopted into the English legal system to define a person's true or permanent home. And it wasn't originally a tax concept, but that changed in the early 20th century. So a bit of history lesson for you all. So in 2014, the UK formally introduced domicile for tax purposes with the creation of the remittance bases. And this allowed individuals, as we understand the rules to be, even today, to be taxed only on UK income and foreign income that was brought into the UK and enjoyed in the UK. So it became a cornerstone of tax planning for international families. And then in 2008, we had the system slightly tightened. So we had the introduction of the annual remittance basis charge. And then in 2017, we had the introduction of the concept of deemed domicile, bringing some long-term residents fully into the UK tax net. And here we are in 2025. We've now seen the most significant change yet. So the abolition of the remittance basis and the removal of domicile as a tax connector. So as of 6th of April, we're already a few weeks, well, nearly a month in. Residence alone will determine tax status, and that's for income tax, capital gains tax, and inheritance tax. So our lovely concept after 200 or so years has now gone away. But you have to remember that this division between domicile and non-domiciles has long been contentious. Those of you might remember the Rishi Sunak wife story. So we've had people living here for decades, building lives and businesses here in the UK, and yet they were still claiming that their true home was overseas. But for now, all you need to remember is that for tax purposes, domicile has gone. But as I've said on the slide, domicile continues to remain relevant for succession purposes, so which country's jurisdiction applies when it comes to inheritance. And we'll be looking at the case study for Fatima shortly, where you'll see that her domicile will remain quite important for succession. And also further note on the fact that domicile hasn't totally gone away. So for certain state tax treaties, for example, the India-UK treaty, we'll still be looking at the common law concept of domicile. So although it's gone for tax purposes, just remember it will never go away for other purposes. So just on to the next slide. So here, I'll take a few minutes to walk you through the key changes, which, as I said, largely came into effect from 6th of April 2025. So first, as I mentioned, the remittance basis is abolished, but please note that this doesn't mean that remittances stop mattering. So any pre-April 2025 foreign income or gains that are brought into the UK after that date will still be taxed if you are or your client's a UK resident. And our government decided they might give the new arrivals a bit of a treat, so they introduced the foreign income and gains regime. In the legislation, you'll see reference to qualifying new resident being the definition for these individuals who could potentially be eligible for the FIG regime. And what this means is that if you have been non-UK resident for at least 10 tax years, and this has got to be 10 consecutive tax years, you will benefit from a 4-year full exemption from UK tax on foreign income and gains, even if they are remitted. So this new regime is free to use and applies regardless of domicile. Sorry, I think I'm behind with my slides. So here we are. We've also got the transitional relief. I'll just go back. We've also got the transitional relief. So these are what I call the sweeteners. So the government introduced a temporary repatriation facility to help individuals who are long-term residents who might have had pre-April 2025 foreign income and gains. So this is a way for them to bring it into the UK, and we'll go into more detail about how this applies in practice and what the lower tax rates are. There's also, and it's not on the slide, there's also another sweetener, the rebasing sweetener. So there is some rebasing allowed, and again, we'll go into the details of that. But the biggest shift has been the shift to inheritance tax regime. So again, we're moving from a domicile-based system to a residence-based system. And you will come across the acronym LTR, which stands for long-term residents. And this is going to be what you're going to look for when advising clients, rather than the concept we used to have, non-doms. So it's a bit long-winded, but we just have to get used to it. So non-long-term resident, but it is what it is. And then the other changes has been in respect of trust, which has seen significant changes. And my colleague Jess will go through what these changes mean for trustees. Trust protections broadly have been withdrawn. So any any income and gains arising in non-UK trust will generally be taxable under UK resident set law. And for IHT purposes, a trust exposure to IHT will follow the set law status. So in summary, we're moving from a domicile driven system and one that's going to be firmly based on UK residents. And in our talk today, we'll be covering how the statutory residence test work. There's been no change to that. The rules still stand, and Jess will walk you through some of the basics for that. Okay, so the new regime, the new FIG regime. So this applies to foreign income and gains, as the name suggests. Who can benefit from it? So as I said before, it's only those who become UK resident after 10 years of non-residence, and then it's only for a 4-year window. So it sounds generous, but it's only for 4 years. And as I said, the statutory residence test will determine whether someone's been non-UK resident for 10 consecutive years. For those that qualify, if they qualify, it doesn't mean that's it. It just, you have to elect for the FIG regime in your tax returns. And the effect is that you will not pay UK tax on foreign income and gains, even if you bring them to the UK. So it's, in my view, quite a, the returns will be complicated, but in theory, the new regime sounds quite simple because it just means 100% exemption and there's no need for complex remittance basis planning. But just a point to remember that if you do elect for, if you are eligible and you do elect for the FIG regime, you will lose your personal allowance, and which is about, I think, 12,500, and then your CGT exemption of £3,000. So as I said, although it's generous, it's only for a short period of time. And once that 4-year window closes, the individual is then taxed on their worldwide income and gains like everyone else. So one point to remember here is that your client might be, or the beneficiary might be eligible, but you still have to think about whether they should elect for the FIG regime, because it might be that they would still want to maintain their personal allowances in relation to UK income. So an analysis has to be done. So more work for advisors, I'm afraid. This is the section that I call the sweetener. So the temporary repatriation facility, and this mostly covers the foreign income and gains from before April 2025. So your FIG regime was for post-April 2025 income and gains. The temporary repatriation facility, the TRF, is for historic pre-April 2025 gains. And what this does is it allows individuals to bring in historic foreign income and gains to the UK at a special rate of 12% or 15%, depending on the year. And there's no further tax if you use this route. And again, the government's plan was to encourage people to bring money into the UK, especially long-term residents or the previous deemed dom individuals, whilst they were still generating some tax revenue. But again, just with any aspect of the legislation, how I'm summarizing it is quite simple, but please note that there are criteria for this. So the TRF would only be available for an individual if they've claimed the remittance basis previously, and you must designate the amount in your tax return. So again, lots of work in relation to how the designation works. And as we are fresh into the tax year, I'm sure we will find out how this will all impact us in practice. Just before I move on to the next slide, I mentioned the concept of rebasing. So we've had rebasing under the old regime. And again, the government has kept this as a sweetener, but in my view, it doesn't really apply to all clients. They've just put it in there, I think. So that what this means is individuals who claimed the remittance basis between 2017 and 2025, they can now rebase foreign assets to their April 2017 value if they sell them after April 2025. So it's a helpful tool, but just remember it's only available for personally held assets, and not many people might have held those assets prior to April 2017 to rebase. Okay, so this is the next section is my favorite section. So we're going to talk about winners and losers. If you're a Liverpool fan, we're obviously winners, but here we're talking about tax. So just focusing on the losers first. So the losers are generally the long-term non-domiciled individuals because initially they would have had the 15-year remittance basis window, and now they just get 4 years, and they will only get that 4 years if, as I said, they qualify for the FIG regime. There's also more complex tax reporting for these individuals, because if you are using the TRF or making an election, then you've got to think about how that's done and work together with your advisors to get that correct. And a final point, split year rules do not apply here. So if someone moves to the UK, say in March of a tax year, they will have used their FIG regime for that particular year, even though they've only spent a month in the UK. So split year rules do not apply. As for the winners, we've got, I think, more winners. So the winners are under the FIG regime or just the income tax and foreign gains regime are those that are looking to move to the UK permanently. So before, you might have had clients who might have been, say, for example, Swiss. You would have said, well, do you want to come here and move permanently? If the answer was yes, then you would look at domicile and say, actually, well, you can't use the favourable regime, the remittance base of taxation. So for those individuals, they are the winners because they can come here with the intention to stay here and still be able to use the FIG regime if they qualify. I think one of my biggest winners, and certainly within my client base, are the returning UK DOMs. So these are individuals with a UK domicile of origin who are coming back to the UK. Before, they would have been very worried about what this would mean in relation to their domicile. They might have friends, families, relatives, or assets that would give them ties to the UK. So we used to do a lot of domicile statements for them, but now the tax rules are quite clear. So for them, if they have been out for 10 consecutive years, then they can use the FIG regime. And also the third winner is the clients to stay fewer than 4 years. So in my head, I've defined this as someone who will take a pit stop in the UK. I know that was not the government's intention, but some people might want to come here, use our FIG regime, then go back. And then the TRF, as I mentioned, so non-DOMs with unremitted income and gains, they can bring them to the UK at the low tax rate, 12% in the next 2 years, and then 15% in the 27-28 tax year. And then, as I mentioned earlier, the rebasing point, so that's might apply to some people. Okay, so moving on to the next slide. So everything that I've said for the past, I don't know, 10, 15 minutes has been all about the foreign income and gains. The IHT has its own treatment. So inheritance tax has also now moved to a residence-based system. And we are coming across the acronym LTR, long-term resident. So if someone has been UK resident for 10 out of the past 20 years, they become an LTR. And once you're an LTR, it's basically the same as becoming domiciled. Your worldwide assets are within scope for IHT. And sadly, if you leave the UK, there's a tail, and you continue to be caught by the UK IHT for up to 10 years, depending on how long you're a resident. So if you are here for less than 9, no tail. Between 10 and 13, you've got 3-year tail, and then each year, so say you've been here 15 years, you get an extra year of tail, and then up to a maximum of 10 years. And so let's have a look at the, and of course, I mentioned at the end of the slide, trusts have had a big impact, and I'll let Jess do all the hard work in relation to that. So let's look at the losers from an inheritance tax point of view. So again, non-DOMs living in the UK between 10 to 15 years. Initially, they would have had 15 years before they were considered deemed DOM and subject to UK IHT. Now this limit has shifted to 10 years. The second losers are the expats who have left the UK, but they're still subject to IHT. And again, the tail, as I said, would differ, but it's up to 10 years. And then Jess will talk about trust. I've put trust here as losers from a compliance perspective. So Jess will touch upon that in her slot. Who are the winners, you might ask? Well, again, same as the FIG regime, these are people who want to permanently move to the UK, and now they can move with that intention. They will now have 10 years before they become subject to IHT. Again, the returning DOMs, so you can see they're winning on both sides. If, say, for example, someone's lived out for 10, 20, 30, 40 years outside of the UK, if they then returned to the UK, they would have been subject to UK IHT in the second year of returning to the UK under those formerly domiciled residence rules. Those rules have now gone away. So for these returning DOMs, they now have 10 years before they become subject to IHT. And again, for those leaving the UK, before we had to advise them about domicile, have they lost their domicile of choice? Have they abandoned their domicile of origin? Now we just move to a straightforward 10-year test. And there's not much of a need for those domicile statements that we used to have. So I would say, although the previous rules were a mess, they were complicated, the government's aim was to make it simpler. I think they have achieved that to an extent because it just now means for the taxpayer there's greater certainty. Domicile itself was quite complicated and opinions could vary depending on who you spoke to. So I hope that's been helpful with setting out the winners and losers. I'll now pass over to Jess, who will take you through the changes for trusts.
Thank you, Yusufa. So I'm going to talk through offshore trusts and their exposure to UK inheritance tax. So going forward, whether or not foreign assets held in a trust are subject to UK IHT will depend on the settlor's residence at the relevant time. The relevant times will include at the trust's 10-year anniversary, when capital distributions are made to beneficiaries, or when a settlor ceases to be long-term resident. So where settlor is long-term resident, then IHT will apply to the foreign assets of the trust. And where settlor is not long-term resident, IHT will not apply to the foreign assets of the trust. Excluding a settlor as a beneficiary of the trust will have no impact on the IHT status of the trust, and the residence or domicile of the beneficiaries will also have no impact on the trust's exposure to IHT, unless, of course, the trust is a bare trust. It's worth noting that if the settlor died before the 6th of April 2025 and they were non-UK domiciled, then IHT will not apply to the foreign assets of the trust going forward. And a quick note on the gift with reservation of benefit rules. If the trust was settled prior to the budget, so 30th of October 2024, these rules were not applied to the trust. So going forward, if assets are settled in a trust and the settlor is able to benefit from those assets, the value of those assets will remain within their estates for IHT purposes if they're long-term residents. So the value of the assets they settle will be subject to UK IHT if they die long-term resident. So we need to just bear this in mind and bear in mind the gift with reservation of benefit rules when we're setting up trusts going forward with UK resident settlors. And now from the 6th of April 2025, if a settlor is long-term resident or once they become long-term resident, the foreign assets of the trust will no longer be excluded property and will instead become subject to the relevant property regime. So you will need to be thinking about the IHT charges that may arise and how these will be funded. So as I mentioned, there will be the 10-year anniversary. So on the trust, once the 10-year anniversary of the trust, and then when assets leave the trust, and for example, when capital distributions are made to beneficiaries, and also when the settlor becomes non-long-term resident. Now, the IHT charge will be a maximum of 6%. The calculation is somewhat complicated, but essentially we're looking at how long the trust assets have been subject to UK IHT. So for non-UK citus assets, for these foreign assets in these trusts, we're looking at the period after the 6th of April 2025 and calculating how long the assets have been within the relevant property regime since the settlor became long-term resident. So obviously if you have a trust with a settlor who is long-term resident as of 6th of April 2025, then all of the foreign assets from that period are within the relevant property regime. The important point to know, which sometimes is overlooked actually, which is if the settlor ceases to be long-term resident, so they leave the UK, there will be an exit charge when they lose their IHT tail, and it won't arise when they leave the UK. So it'll be when they lose the IHT tail. So let's say you have a settlor who leaves the UK with a 10-year IHT tail. So after 10 years of non-residence, they're no longer in the UK IHT net and they cease to be long-term residents. The exit charge will arise on the trust then at that 10-year period, at that 10-year point after they've left the UK. But after that, there will be no longer any exposure to the relevant property regime. The trust assets will no longer be subject to UK IHT. They will then be excluded property again. Now I'm going to turn to income and capital gains and trust distributions. So when the trust is settlor interested, so the settlor is a beneficiary of the trust, the income and gains of the trust will be assessed on the settlor if they are UK tax resident and they do not qualify for the FIG regime, which Yusufa talked about earlier. In relation to any capital distributions made from the trust or benefits that are given to UK resident beneficiaries, and that also includes the settlor, our anti-avoidance rules will continue to apply, and those benefits or capital distributions that are made will first match to the pre-6th of April foreign income and gains in the trust. So to the extent that the value of any benefit is matched to pre-6th of April income and gains, the beneficiary will be subject to UK income tax or capital gains tax, unless, of course, they themselves, the beneficiary that is, qualify for the FIG regime. If they do not qualify for the FIG regime and they were previously remittance basis taxpayers, they can use the TRF at 12% or 15%, depending on the year of distribution, so that they pay that lower rate of tax. We also need to just be careful with onward gifting rules. What you can't do is have a distribution made to a beneficiary that claims the FIG regime, so they essentially pay no UK tax on that distribution, if the intention is that they will essentially transfer that distribution to a beneficiary that is unable to use the FIG regime. So had that secondary beneficiary actually received the distribution outright from the trust, they would have paid UK tax on it. So that's just an anti-avoidance measure to stop that happening. Now I think I'll be passing on to Leslie to take us through the case study.
Thanks, Jess. So we've just explored the sweeping changes to the UK tax landscape, from the phasing out of the non-dom regime to the introduction of the new FIG regime. We've looked at the winners and losers under the new rules, the impacts on trust and inheritance tax, and the often complex matching rules that apply to distributions. But what does all of this actually look like in practice? So what we've done is to help bring these changes to life, we're going to walk through the first of two real-world inspired case studies that highlight the kind of challenges and opportunities that advisors, trustees and internationally mobile families are facing today. So we're going to start with Fatima. So Fatima's 46 years old. She's an Emirati national who's never lived in the UK. She's a successful entrepreneur and investor with 3 children, 2 daughters and 1 son. Her assets base includes a UK residential property generating rental income, as well as offshore investments, cash shares and an international investment portfolio. Her main concerns are nuanced and forward-looking. She wants to maximise the benefits of the FIG regime, ensure equality in succession planning between her children, and importantly, navigate inheritance planning in a way that allows her to bypass the default application of Sharia law. So how do these UK tax changes affect someone like Fatima? Let's explore some of the key considerations and the plan and opportunities. We're going to go to Yusufa.
So Fatima's plan is to come to the UK. She's your perfect client to come under the eligibility for the FIG regime. She's never been UK tax resident, so she can use the FIG for her 4 years of UK residence, and then after that she'll be taxed on worldwide income and gains. So her foreign income and gains in the first 4 years are exempt, even if she brings them to the UK. So anything she brings in relation to her investment portfolio and shares will be exempt. Her UK income tax, and this is the point to remember, is that because she's got a rental property in the UK, the FIG regime is not going to cover UK taxes. So UK income tax will still be payable on her UK property, and we can't change that under the FIG. In relation to her portfolio, depending on how long she wants to stay in the UK, we can definitely reorganize that in the window with more flexibility. So that's from a gains perspective. If, for example, income perspective, from a gains perspective, if she does end up selling any of her non-UK assets, she can do so during the FIG period. In relation to IHT, so as I've mentioned before, we'll need to look to see when she'll become an LTR, long-term resident. So if she stays here for 10 or more years, then she will be subject to the LTR. But I think from the facts, or I might be making this up, she intends to leave before then. And in relation to her equality and succession planning, so for her, she's Emirati. We will look at the concept of domicile from a common law perspective. As I said, it's still relevant when it comes to succession. So for her, she might be the perfect candidate to think of an offshore trust. She also, it says on the notes, she also wants to bypass Sharia law. So again, clients who do want to circumvent Sharia often do set up offshore trusts, and she would be, from a UK perspective, fine to do that, obviously, with keeping an eye on her residence going forward. So for her, a trust would be fine. And because we're doing this with Sentient, so an Isle of Man trust might be good. And then Neil and Leslie can advise on that. But I think the key point here is equality and succession planning. So as you can see from the notes, she's got 2 daughters and 1 son. And under Sharia law, as most of you will be aware, the son gets double the share of the daughters. So again, she can use a trust to achieve equality and essentially get around the Sharia rules. We're silent on the facts about what she has in the UAE, so that will be treated separately. But anything that she holds to the outside of the UAE, we could potentially use an offshore trust for that. So Fatima is your perfect client from a UK perspective, and also perfect example to use an offshore trust.
Thanks, Yusufa. That's a really insightful look at how Fatima's situation highlights some of the key planning opportunities. What we are going to now look at, as you'll have gathered, a recurring theme, not just in Fatima's case, but in the wider planning context, is the importance of residence. So many of the tax changes we've discussed hinge on a single question: is the individual UK resident or not? And under the new FIG regime, that question becomes even more critical, especially when we start talking about timing, eligibility, and how long planning windows stay open. So before we move on to our next case study, I'm going to go to Jess, who's going to go through exactly what determines UK tax residence, the UK statutory residence test, its key components, and the implications of becoming or ceasing to be UK resident under the current and upcoming rules. Over to you, Jess.
Thank you. So with everything mentioned so far, you can see that residence is key. So tax residence in the UK is determined by the UK statutory residence test. And whilst domicile no longer is relevant for UK tax purposes, it will continue to be relevant for succession purposes and certain pre-1975 IHT treaties, as mentioned by Yusufa. It's important to remember that domicile is different from residence or nationality. You might be resident in one country, you could be a citizen of a different country, and then also domiciled in a third country. So all 3 are different. So I'm going to run through the UK statutory residence test. So there are 3 parts. The first part looks at whether an individual is automatically UK tax resident. The next part looks at whether you are automatically non-UK tax resident. And then the third part looks at where we end up with most clients actually is a sufficient ties test, which looks at the ties you have to the UK. And from there, you look at how many days you can spend in the UK without becoming UK tax resident. So the first test looks at whether you have been, so this is the automatic UK residence test. And the first part of that looks at whether you have been present in the UK for 183 days during the tax year. Now, most clients think this is the main and only test we have for residents, so we need to be careful here. You may not have spent 183 days in the UK, so you might think, okay, so I'm not automatically UK resident then, but actually you need to qualify as automatically non-resident, and if you don't, then you're having to look at the sufficient ties test, and this significantly can limit how many days you can spend in the UK, and I'll come on to that in a bit. The second test here is the home test. So you are automatically UK resident if you have a home in the UK, and there's a 91-day period in which you have no overseas home, or you have an overseas home, but you have not spent, you've spent less than 30 days there in the tax year. So the third test is quite self-explanatory. You just essentially look at whether you're working full-time in the UK. Now, moving on to being automatically non-UK resident. So if you don't qualify as automatically UK tax resident, we look at these tests to see if you are automatically non-resident. These are pretty self-explanatory as well. The first is if you've been UK resident in the last 3 tax years, then you're automatically non-resident if you spend less than 16 days. And if you've been non-resident for the last 3 tax years, then your limit is less than 45 days to be non-UK tax resident. The third test is you have to work full-time overseas and essentially spend no more than 90 days in the UK in the relevant tax year. And then we move on to the sufficient ties test. So you are not automatically UK resident, you're not automatically non-UK resident. So we need to look at how many ties you have, and that will dictate how many days you can spend in the UK without becoming UK tax resident. So broadly, I'm going to go through the ties here. So we have the family tie. You have this tie if your spouse or minor child are UK tax resident themselves. You have the accommodation tie. If you have a place available to you for a continuous period of at least 91 days. Please bear in mind that this doesn't have to be your home or a property that you own, for example. It has nothing to do with ownership. It's just a place that is available to you, and so can include a hotel or even a sort of a social club, for example. The work tie, you'll have this tie if you work in the UK on 40 or more days. You have the 90-day tie if you spend more than 90 days in the UK in one or both of the preceding 2 tax years. And then we have finally the country tie. That's if you spend, you'll have this tie if you spend more time in the UK than any other country, but this only applies to someone who is treated as a leaver. So when you're looking at the day counts, how many days you can spend in the UK without becoming UK tax resident will depend on whether you are an arriver or a leaver. If you're an arriver, you are someone who has not been UK tax resident in the last 3 years, and you'll be a leaver if you have been resident in one of the preceding 3 tax years. And then once you've determined whether you're an arriver or a leaver, then you look at how many ties you have, and then that will dictate how many days you can spend in the UK. So, and then your ties and day counts need to be considered year on year. So then moving on to dual residency, just a point to note that you can be tax resident in 2 jurisdictions at the same time. So you can be UK tax resident and then resident elsewhere. In these circumstances, we'll look at whether the UK has a double tax treaty with the relevant country, and you'll look at trying to eliminate double taxation so that the individual is not taxed twice on the same income and gains. And we also have double tax treaties specifically for IHT purposes. The treaties will contain a series of tiebreaker tests, which essentially look at determining where the individual is treaty tax resident for the purposes of looking at which country has primary or sole taxing rights. And then very, very broadly, the tiebreakers include looking at where an individual has a home. If you have a home in both jurisdictions, then you look at the next test, which is centre of vital interest. So where have you got economic and personal connections? And then if that's inconclusive, you look at nationality. And then if all sort of fails, then you look at you're looking at it being determined by the relevant tax authorities. So Next, just very quickly looking at the implications of UK tax residence for individuals. Tax residence is obviously relevant to determine whether you're eligible for the FIG regime. It's also extremely relevant to determine how long your IHT tail is if you leave the UK and your IHT exposure generally. For trusts, it's relevant if to determine when the trust assets fall into the relevant property regime and they're subject to UK IHT. And just be mindful that if that there might be other individuals who have added value to the trust, so not the original set law or the individual named as a set law on the trust deed. You might have others who have added to trusts. Their residence needs to be considered because they might be treated as a set law for UK tax purposes. And that might have an impact. And then additionally, we have the transitional relief, so historic remittance basis taxpayers. It's not too late for them to claim the remittance basis if they didn't, and that would then make them eligible for the TRF, which is a valuable relief for the next 3 years. And now I'll pass on to Leslie to take us through the next case study.
Thanks, Jess. So we have explored the UK statutory residence test and how pivotal resident status is to tax planning under the new regime. So let's look at a very different but equally relevant scenario in our second case study. So we've now got Fabrice. He's a Swiss national, 52 years old and a long-term UK resident, over 12 years and counting. He's got children in the UK education system and has no intention of leaving the UK in the near future. Like many internationally mobile families, Fabrice has assets structured offshore, including an existing trust and a separate investment portfolio. But here's the issue, and it's one many long-term residents now face, and that is that the exclusions he previously relied on, particularly around foreign income and gains, will fall away. So suddenly his trust may be within the scope of UK income tax and crucially UK inheritance tax. So for this particular case study brings us to a vital turning point in our conversation, not just about individuals, but about the responsibilities of trustees. And as the structures begin to fall within scope, particularly those based offshore, there's going to be a lot of new questions trustees must now ask themselves. So to look more closely at Fabrice's structure, I'm going to go back to Jess just to look around what options might be available to him in this scenario.
Right, so Fabrice is the set law and also beneficiary. So obviously income and capital gains tax, income and capital gains of the trust are going to be assessed and attributed to him and taxed at his marginal rates of tax. So additionally, the income and gains of the underlying investment portfolio, which for our purposes, we're going to say is held through an Isle of Man company, is also going to be assessed on him unless he can claim the motive defence. So one of the points to look at is whether Fabrice can claim the motive defence to stop the attribution of income and gains on him. Now, for income tax purposes, broadly, we're looking at whether he set up the trust, whether UK tax was one of the reasons why he set up the trust, or whether commercial reasons, for example. And for capital gains tax purposes, we're looking at whether CGT or corporation tax was one of the reasons for settling the assets in this structure. The motive defence has to be claimed in a tax return, but if it applies and it's accepted, then essentially income and gains are, of the underlying structure will not be assessed on Fabrice. But if it's not, then it will be assessed on him. Now, let's assume that Fabrice set up this structure before he became UK deemed domiciled. So this was planning that many non-doms did before they reached 15 years of UK residence. In that case, it's unlikely the motive defence will apply. So then we look at, well, what are the income and gains arising in the trust structure, and can we minimise this in some way? So we might be looking at essentially moving from income producing assets to a capital gains position because that's more favourable, CGT being at 24% rather than 45% income tax rate. We also might want to look at the trust's historic income and gains pools and whether Fabrice might want to use a TRF to get some of those out and pay 12% or 15% on those amounts. From an IHT perspective, Fabrice is long-term resident, so the IHT asset the foreign assets in the trust will now be subject to UKIHT at the 10-year anniversary and on any exits. That's a maximum 6%. But let's say that Fabrice intends to leave in the future, leave the UK. There will also be an exit charge there when he loses his IHT tail. However, we can plan for those IHT liabilities, and in spite of the tax consequences, the trust still remains a good vehicle for succession and asset protection. His children are minors, and one day he intends to leave the UK. And when he is outside of the UK IHT net and he ceases to be long-term resident, then the foreign assets in the trust will no longer be subject to UK IHT. And if Fabrice otherwise wound up the trust, for example, then those assets would be in his estate and possibly subject to UKIHT at 40%, rather than remaining in the trust and only subject to IHT at a maximum of 6%. So there's a risk there of sort of undoing what is otherwise a good asset protection vehicle. And essentially, those are the general points really to consider.
Great. Thanks, Jess. I think this actually leads us nicely on to Neil, so he can talk about the role of the trustee in this kind of scenario, and explore sort of the practical concerns and important considerations for trustees amid the new tax rules. So Neil, I'll hand over to you.
Thank you, Leslie. So I know that there's a number of trustees probably attending the webinar today. And I think, I'm sure that many of you have attended webinars and talks all on this subject. And I think, you probably can't get enough webinars to try and take in everything that we need to take in. And I'm sure a lot of you have been busy over the last few months restructuring for clients that are either being caught or potentially opportunities to take advantage of with the new regime. But this first slide that I've got up here, it's meant to look complex and complicated. And you can see by the number of acronyms what a difficult job it is for us as trustees to try and remember what all of these mean and what the impact of all of these things are in terms of how we go about our business and how we act as trustees. So it's a complex web. It's very difficult for trustees to navigate. I think there's no shame also in not trying to be a tax expert as a trustee. That's not our role. So I think it just highlights now more than ever that we do need to collaborate with professionals. We need to get tax advice. It's for our benefit as trustees, and it's for the benefit of our clients. So help is at hand is what I'm trying to say whenever we're looking at complex issues like this. So, I mean, anyone looking at this sort of brainstorming map here, you'll see lots of terms that you're familiar with here. How they all connect is quite difficult to navigate, but they're all things that we've heard of before. We are going to be seeing changes come about, obviously, as a result of the changes post 5th of April this year. And that's what I'm going to come on to now with the next slide, to kind of point out really the things that we've lost as a result of the tax changes and some of the things that are being introduced, and also some of the things that still are with us, sadly. I'll come on to those. So I'm going to start, as you look at it, at 10 o'clock on this brainstorming map, where you can see I've put a strike through the RBU. So that's indicates obviously there's no longer remittance basis users. That is effectively, as I understand it, being replaced by the FIG regime. And I should say as well at this point, since we have the tax experts online, if there's anything that I slip up on here or I've misunderstood, please do feel free to jump in, Yusuf or Jess, to correct me. If we continue to go anti-clockwise round the wheel here, you'll see below that I've crossed out cleansing and washing out. These are terms that we've been familiar with over the years that have caused some headaches in terms of tax pools and that sort of thing, which we'll come on to a little bit more in more detail shortly. But from my understanding, we effectively have the TRF as an alternative mechanism for cleansing and washing out. It is temporary by its name, temporary repatriation facility, but there may be opportunities here within this limited time frame, you know, for beneficiaries to receive distributions and reduce those tax pools that we're familiar with. Continuing anti-clockwise, I've circled some more acronyms down here in green, things that are sort of still relevant to the previous regime, and some things that are new to us. So obviously capital gains tax we're familiar with in terms of trust exposure in the UK. Inheritance tax, similarly, we're all familiar with that, the 10-year charges, the exit charges that we're all used to as trustees. And the trust registration service is something that I think as trustees we need to think about, and I'll come on to that in light of the new changes shortly. And also here we've got the long-term residence sort of concept. That's obviously a new thing. We know all about the statutory residence test because that was in place before, but the concept of LTR is something new, and it's something that we're going to have to adapt to over time. I'm going to continue going to 3 o'clock now on this chart, where I've circled tainting. Tainting again is something that we've been familiar with as trustees. You know, adding value to trusts that enjoyed protected trust status. That's nothing new. We've always known that we've got to be careful about adding value and the status of the settler, but I think it comes more into focus now with settlers being caught by the long-term resident status, and I'll just come on to how we manage that in a bit more detail shortly. And then at 12 o'clock we've got I've highlighted there the SRT, statutory residence test. It's just increasingly important now that we know what we're looking at, and that we collaborate with advisors to make sure our clients don't kind of fall into traps, and then we don't fall into traps at the same time either. So from a trustee perspective, what are the practical implications for trustees? And the way that I'm looking at this, or the way I interpret it, is there are opportunities arising from the FIG and TRF regime. And on the other side of the coin, with the LTR sort of classification and removal of the domicile concept, this actually presents challenges for us as trustees. I think going forward, we need to be able to differentiate between protected trusts and non-protected trusts. The protected trusts that we've been familiar with under the protected trust regime, you know, they would have had to have been set up before the 5th of April 2025, and I don't think there's anything, Jess or Yusufa will correct me if I'm wrong, but that's pretty much behind us completely now with the protected trust regime. Everything is pretty much relevant property. So I think also we need to be aware that there's increased importance on the statutory residence test. We're all familiar with how, I mean, Jess went through just before with the connecting factors, or I used to call them, I don't know if they've changed their name to sufficient ties now, but I used to call them connecting factors. But I think we all know what they are. They're nothing new to us, but it's increasingly important, obviously, to monitor that, as I've already covered. And this status as a long-term resident for our settlers out there, and as Jess said before, it's at the end of the tail after a person has left the UK that an exit charge can arise, that we need to be very much aware of that time period, because obviously when that trigger event occurs, we may then be required to, from the trust, pay an exit charge to HMRC, and such tax liability or exposure to UK tax will actually trigger potentially a requirement for the trust registration service. We are already familiar with that. There's obviously no changes to the trust registration service, but there may be trusts that haven't had UK tax exposure previously, and as a result of the changes here and people becoming, I was going to say domiciled then, but becoming long-term residents, that could have an implication on all sorts of sort of, you know, reporting and administrative things that we need to do as trustees to make sure we're compliant. So I've also got a point here that sadly we have matching rules continuing. I think there's a few people out there that were hoping that the matching rules might go away with these changes. The reality is that those rules remain. And so obviously we need to continue. Hopefully everyone's been, I mean, the reason I say hopefully is because I've seen it in the past where tax pools have not been properly prepared in the past. And when it comes to making distributions, that can be a little bit preventative and problematic when it comes to distributions, because beneficiaries can sometimes be reluctant to take beneficiaries because they don't know what to report in terms of matching because the accounts have not been done properly. So I think, and I will come on to that in a bit more detail, I think that's a really important issue for us as trustees for the matching rules. And finally, on this page, CRS reporting. You know, I think when we're reporting distributions, we need to make sure that our beneficiaries are reporting pretty much the same. With the FIG regime, you have to apply for it. Same with the motive defence as well. When filling out tax forms, obviously, and taking advantage of the incentives, they can come with it greater scrutiny by HMRC. So under greater scrutiny, I think it's really, really important that we have consistent reporting. And so CRS, I think, you know, can play an important part in that. And I think, again, I'm going to highlight this probably a few times before we're finished, but collaboration with tax advisors and our clients, communications with our clients is of utmost importance. Okay, on to the next slide. So this really covers mostly what we've spoken about on the previous page, but I feel like it's just worth emphasizing further, you know, what we need to be looking at as trustees and why it's important. So understanding settler and beneficiary tax status, we've covered that in detail now. And with the statutory residence test being more important than ever, and this all ties into attribution, matching rules, tainting, they're all things that we need to consider as trustees and that beneficiaries and settlers need to consider themselves as well. Accurate and reliable accounting records goes without saying, you know, that in today's landscape, you need to have accurate records. And for the tax pool side of things, obviously the matching rules still remain. And with the new incentives that are in play now with the FIG regime, it's a great idea to if you haven't already, start making accurate records. Careful governance and monitoring. I mean, I think that's something we as trustees are always mindful of. It's a bit of a given, but I think with the sort of shift that we're going through now in this transitional phase in adapting to the new rules, you know, we need guidance, obviously, from our tax experts, but we really need to be making sure that we are complying where we need to comply and doing the appropriate planning. And I think that sort of leads nicely into the strategic considerations, because we as trustees, you know, we may have certain patterns that we've become used to, particularly with pre-existing trusts. That could be distribution patterns, investment policies. You know, I think with the changes that have come in, we need to be looking at do our trust deeds in terms of the dispositive powers that are written in, are they fit for purpose? Are our letters of wishes in keeping with what we want to achieve? And are our distributions appropriate for what the trust is trying to achieve and in compliance with what the beneficiaries need to do? Similarly with investments, you know, we would have previously, under the excluded property regime, avoided UK cited assets. You know, we need to look at that now and see, you know, if there's, can we be a little bit more flexible in with our investment policy. So then on the next slide, our approach to this. I mean, I think I've covered this more or less already in terms of how we collaborate with fellow professionals. But I think really the big, you know, an important point here that I think we should consider is that many of the individuals who will be setting up new structures under the FIG regime, they will be coming to the UK for the first time. and they might not be familiar with trusts. So I think the point about educating beneficiaries, educating settlers becomes really important, and I think this is a great opportunity for us to do that. Deep knowledge of the UK and international tax landscape. We are mere trustees. We stick to what we do and we try to learn what we can. But you know, we can't know everything. So I think we have to accept that and engage professionals where we need. So that's where the likes of Yusufa and Jess come in. I'm going to come on to why the Isle of Man is a particularly good location. Obviously, Sentient International is based in the Isle of Man, so we have a slight bias. There are other good jurisdictions available. But why the Isle of Man? I mean, I think it comes down to track record. You know, we're a common law jurisdiction that's had a trust act for a long, long time. And our jurisdiction has been well known in the industry. We're very well regulated, politically, financially stable. But for me, the sort of biggest points are that we have a history, a strong history of dealing with UK res non-dom structures. So we understand very well the tax landscape, and we're well placed to adapt to tax changes going forward as a jurisdiction. And in addition to that, I would add that I think we have very strong accounting skills on the island. You know, I have worked in other places, other jurisdictions, and I have to say it's almost sort of an accountancy first based place here, although you know, that's up to debate. But anyway, what I would say is that it's a great place to come and do business, and we are very professional and we know what we're doing, and we're here to help. And that's why you should choose Sentient International. We have great expertise in this field. We are actually this year celebrating our 40th year. So we've been doing business for a long time. A lot of our business has been based around non-dom structures. And we have a great network to draw on, the likes of Irwin and Mitchell being one of them. So I think that concludes my input.
Thanks, Neil. Okay, so we've just had a very good walkthrough of not just the technical implications, but also the sort of human considerations that come with long-term UK residents. But what really stood out for me was the focus on preparedness. And you know that the upcoming changes, particularly the end of certain exclusions for long-term residents, mean we're entering a sort of more complex, more scrutinised environment. But complexity doesn't actually have to mean catastrophe. It just means we've got to be sharper, earlier, and more joined up in our thinking, which I think Neil's kind of emphasised in his points there as well. You've also touched on the importance of trustee readiness, Neil, and that's something we obviously know a fair bit about at Sentient International. But taking all this into account, I want to bring it back around to the sort of original question and the title of this webinar, in that, is it doom or boom, or is there still a future for trusts in the UK tax landscape? So I'm going to put that exact question to each of our panellists, starting with Jess.
I don't think it's all doom. I think there's some boom here. I think essentially all we've done is move offshore trusts into the same space that UK trusts were in. They've always been created from an asset protection, succession planning perspective. And it's just a question of managing you know, the inheritance tax, income and capital gains tax exposure. As Yusufa mentioned, there's winners, there's losers, but there's still a lot of positives here in terms of creating trusts, retaining trusts, and it's very much individual focus. So what a set law is happy to accept in terms of tax liabilities, is it for a short period before they leave the UK? There's loads of considerations. So I think not doom, let's say it's boom.
I like that answer. I'm also going to ask the same to Neil. What's your thoughts?
Yeah, well, I agree with Jess. I'm certainly not here to say doom. I'm here to say boom. I think we all need to remain optimistic. You know, I think it's nothing new that we are facing sort of changes or challenges in our industry. we've come across changes and challenges plenty of times before. You know, I think there's still plenty of opportunities. A lot of people would argue that it's not as good as it was before, which I would tend to agree with, but that certainly there's planning opportunities and incentives for people to come to the UK and for the use case of trusts. And who knows what might come in the future as well. Trusts are long-lasting vehicles and they're adaptable to change. So I'm boom also.
Great. Another positive answer. And Yusufa, any
I'd
other
love to
additional
be-
comments?
I'd love to be controversial and say doom, but I'm actually going for boom. Just because, as we all know, trusts are not just used for tax purposes. It's got other benefits, asset protection, next generation planning. They're here to stay. And for those in the UK, you might remember we had the 2006 changes in relation to trusts. We're still dealing with trusts now. So I think the future's quite bright. It will just mean more monitoring as a trustee point of view as to how they operate and more compliance, I would say, but they're here to stay. So I'm going boom.
Great. So we've had some brilliant insights there and a great reminder that while the landscape is shifting, it's not collapsing, it's evolving, and with evolution comes opportunity. We've also had a few questions coming through the chat and prior to the session. So I'm going to just try and push through some of those as quickly as possible in the remaining time that we have. First one I'm going to put to you, Jess. The new regime is going to be attractive to some people, but for those that it isn't, where will or should they look to go?
So I think it's very fact dependent. So it's not entirely driven by tax, but obviously a lot of clients will look at where is tax favourable to reside in and essentially just manage their day count from a UK tax perspective if they need to spend some time in the UK. But it is very much driven by where they might have themselves ties or where they feel that they'd be comfortable living. So we've seen people move to Italy, Dubai, Switzerland. I mean, it's really varied and fact dependent.
Great, thank you. So when dealing with Islamic succession planning under the new regime, what are some of the biggest pitfalls that trustees and advisors should be aware of? I think that one's best suited to you, Yusufa.
I think with succession planning, as I said before, the concept of domicile states. So we'll still be looking at that concept when it comes to Islamic planning. We'll be looking at the usual rules. Is trust a good vehicle going forward for this particular client? What is their residence status in the UK if they have a connection to the UK? But from an Islamic perspective, I mean, you can get yourself in all sorts of pitfalls if you don't understand the rules. But I would say don't shy away if a client asks you about that particular aspect. A lot of people are trying to align their succession planning with their religious upbringing or beliefs, etc. So don't shy away from it. And as long as they plan early, there are definitely opportunities to avoid any pitfalls.
Thank you. Neil, I'm going to direct this one to you. How should trustees approach the review of existing offshore structures in light of these reforms? Is it a case of tweak and adapt or start from scratch?
Well, I think in a lot of cases, professional trustees have already been reviewing their existing cases. Certainly, you know, where I've been involved, we've had to look at our structures and see where the new rules are going to potentially change things in terms of tax treatment. So I think that review process will have started for most people. So I think in terms of starting from scratch, well, yeah, we will be starting from scratch in terms of new cases, but those existing cases we're just going to be building on what we had before in their sort of restructured form where restructuring has taken place, or if appropriate action hasn't been taken in those cases, then we need to adapt because we need to realise where exposure is and comply accordingly.
Thank you. I am conscious of time running out, so I'm going to end with one final question, which I'm actually going to direct to each of you. If you could give one piece of advice to trustees or private client advisors preparing for the post-2025 world, what would it be? I'll start with you.
Oh, Leslie, you muted.
Yeah, we couldn't hear you said.
Oh, she's still on mute.
Apologies. I was just saying, so for one last question, I'm going to bring that back around to each of you to ask one question. And that is going to be, if you could give one piece of advice to trustees or private client advisors that are preparing for the post-2025 world, what would it be? I'll start with you, Neil.
Okay, mine's short and sweet. It's choose the Isle of Man and choose Sentient International. Is that too much of a sell?
The plug. Okay, to you, Jess.
Shall I follow Neil's and say use Irwin Mitchell? No, I'm going to say working collaboratively, which Neil touched on in any event, but it's working with trustees, tax advisors, the beneficiaries, set law, and being aligned with objectives, looking at the tax planning, and yeah, just working collaboratively. I think that's going to be the most important thing going forward.
Great. And finally with you, Yusufa.
My message is short and simple. For trustees, stay informed with the current developments, seek advice where possible, and just remember that any tax consequences in relation to the trusts from now on will be the trustees' responsibility in relation to the exit charges, etc. So if the trustees are informed about what's happening, they will end up doing a good job for their clients.
Thank you very much. So yeah, that kind of brings us to the end of our webinar. We have run out of time, but I think everyone will agree it's been a great session. Lots of insight and lots of practical takeaways that people can go away with. I want to say a huge thank you to our speakers, so Neil, Yusufa and Jessica, who have shared their expertise and their insights today. I think we can all agree that you've given us a lot to think about. And thank you, of course, to everybody for joining. We hope that you found the webinar both informative and useful as you navigate these changes. Just to let you know that a recording of today's session will be sent to everybody in the next few days. But if you do have any further questions or you'd like to discuss anything that you've heard today in more detail, please do reach out to us at Sentient or with Jess and Yusufa at Irwin Mitchell. We'd obviously be delighted to continue the conversation. But on behalf of Sentient International and Irwin Mitchell, I'd like to thank you for your time, your questions and your engagement today. And we look forward to staying connected. See you soon.